Hello and welcome to another brand new episode of What the FinTech, the podcast from the team behind FinTech Futures and the Banking Technology magazine. My name is Paul Hindle, Managing Editor at FinTech Futures, and for this episode we're joined by Timothy Flacke, Co-founder and CEO of Commonwealth. Tim, welcome to the show.
Thanks so much, Paul. I'm really excited to join.
Excellent. It's great to have you here. And just to get started, would you like to quickly let us know a bit more about yourself and Commonwealth then?
Sure. So Commonwealth may be a little bit unusual in the sense that we are an NGO, or here in the States, we talk about being a 501c3, so we're a charity. But our mission is financial security and opportunity for people living on low and moderate incomes. LMI, is our jargon. And we pursue that by working closely with a bunch of stakeholders, including fintechs. So that's us in a nutshell. We have kind of this privilege, really, of pursuing work that I think is just fundamental to a healthy society and a healthy economy, and certainly important for individual households. And we, again, have this kind of luxury of doing that from a mission-first perspective, working closely with the fintechs, the financial service firms, employers, and those that support employers, and some policymakers, because those are the actors that really shape the landscape for tens of millions of people. And that is our humble aspiration, is to have a positive impact for a whole lot of people for whom their financial lives are just central to their well-being overall.
Excellent. Sounds great. And again, great to have you here. And thanks so much for taking the time out to speak with us today. So on the show this week, we'll be exploring the critical work of advancing financial inclusion for families and individuals in the US, and how Commonwealth has been at the forefront of testing and scaling innovative solutions to help consumers build financial security. With Commonwealth celebrating its 25th anniversary this year, we'll discuss how the organization's approach has evolved over the years, its most significant accomplishments, and why this anniversary is as much about preparing for the future as it is about celebrating past successes. Our conversation will examine the evolving landscape of financial security, including the work Commonwealth is doing in the space to support consumers, what the broader industry needs to be doing more of to help further advance financial inclusion, and the opportunities and risks presented by emerging technologies such as agentic and generative AI. And finally, we'll learn more about Commonwealth's Vision 2027, exploring the strategic priorities that will guide the organization's work and its plans for the next generation of inclusive financial products. So to start off with then, Tim, as I mentioned there, Commonwealth celebrating its 25th anniversary this year. When you co-founded the organization in 2001, what was your vision then, and how has that evolved over the past quarter century?
Yeah, I really appreciate that question. It is crazy that 25 years have gone by. To answer your question, really where we were back in the late 1990s, a couple of things came together that resulted in us starting this new enterprise. One was the rapid changes in technology, right? So the very end of the 1990s was kind of the first wave of the internet boom. And even in how we set up our own operations, we used to say we were doing something that wouldn't have been possible a couple of years earlier because we had an internet connection and a couple of laptops and could get started in a very quick and nimble way. But the second really important thing that was happening was a realization, at least in US social policy circles, that a lot of our focus on households' financial well-being had really just been about the income side. And of course, that's super important, right? We need income. We need food on our table and a roof over our head. But that in a strange way, a lot of those conversations weren't getting at the heart of the long-term issue for households, which is much more about wealth, or we used to talk about assets. And what excited us, and the us in this case is myself. I was at the time a graduate student, and a gentleman named Peter Tufano, who is a finance professor by training. Actually, it's fun. I know you're based in the UK. Peter was the dean of the Said Business School at Oxford for a decade, so has some UK connections. And a third gentleman, we got working together and said, this question of how do we enable asset creation and wealth creation for households, that is really important. And we don't see a lot of people thinking about that for those living under the median income, kind of living paycheck to paycheck. So to answer your question, that was really the core idea then, and it remains the case now, kind of wealth creation as the North Star. I think we've learned a lot along the way. It's funny, when we started, this notion of FinTech was not even a thing. That was not a phrase that existed. It sounds a little surprising to remember there was a time before we even had mobile devices in our phone. At that point, the internet itself was still a novelty. And one of our founding ideas really was that even people who didn't have a lot of money could and should access financial services directly through the internet. And honestly, we took some flack for that. People said, I don't know, that's not necessarily reasonable or fair to expect people who don't have a lot of money or resources to serve themselves. I think it's turned out that's the case, that all of us actually can and want to use some degree of self-service tools. But to answer your question, so that's the original vision. It continues to be the North Star for our work. I think we have learned along the way that you can't only focus on the long term, on the balance sheet, without also recognizing that just so many of us live in a state of concern about our current finances and the day-to-day and making it through the week, making it through the month. So we've continued to do that work now in various ways for those past 2.5 decades.
Excellent. I guess building on that, what would you say are some of the biggest achievements for Commonwealth over the past 25 years?
Yeah, I appreciate that question. I think, first of all, just to say it, I mean, we are very fortunate to work as part of a community or ecosystem of organizations. And it's very hard to tease out what is any one organization's contribution. But I think some of the things we're proud to have contributed to is, first of all, I think really demonstrated that, again, honestly, half of the population, definitionally, if we think under the median income, that half of the population does, in fact, want to save and invest and use technology and be part of the financial system. And that might seem kind of obvious, but there had been real questions, especially when we got started, about whether or not people could save money if they didn't have a lot of income. So I don't think that's a conversation that we have nearly as much anymore. I think it's much more the mainstream view that all of us need to be included in our thinking about who gets served and how they get served. I think the second thing that we feel proud to have contributed to, and the language on this is always a little bit tricky, but that we can take on large system level challenges. And I think we learned a lot about how to do that. And I appreciate that's kind of abstract language, so I can quickly use a concrete example that's been really close to our hearts. Over the last 7 or 8 years, really in the States, we've tried to make it much more possible for that working family to build up a cushion, a reserve of savings. And it's a pretty basic financial function, but in fact, it has been really hard for households to have the tools to do that. The US Federal Reserve has kind of famously asked people every year how they would handle a $400 unexpected expense. And the figure has hovered around 40% who have said they couldn't do that without basically by drawing on savings. So what we've been able to do over that period of time is make it on the agenda for employers that they should offer tools to help their workers build up cushions of savings. In a US context, we've embedded it or into the retirement savings system so that people are thinking about how we prepare for decades from now, are now also offering tools to help us prepare for tomorrow. We've seen financial services embrace this, specifically FinTech. There are some specialized FinTechs that are creating short-term savings tools. And we've seen policymakers from the US Congress to some of our regulators take action. So what I'm trying to get back to is, here is a big issue that touches many, many people. And over a period of time, by working in the marketplace with various different providers, with policymakers, with researchers, we've shifted that conversation. And you now go to industry conferences and you mention something about emergency savings and everyone goes, oh yeah, right, we have a solution, we're thinking about that. So I think that's the second thing that's really shifted. And we feel a great sense of pride for having contributed to that we can take on these complicated challenges and work together. And a piece of that is that some of the marquee actors have really stepped up and done big things. We've had the privilege over our time of working, for example, with Walmart, who introduced a savings feature on their money card, their prepaid card product, that generated billions of dollars in savings for a client base that is definitely, by and large, living paycheck to paycheck. Or ADP, which is the largest payroll provider by far in the US, similarly added a savings feature to their pay card that generated well over $1.5 billion of savings. So that's an example of some of the leading lights that cause that system change. And then I guess the last thing I would say that we're proud of is there have been some very specific changes. Some of them go back to public infrastructure. We helped our Internal Revenue Service, our taxing agency, to make the case for and ultimately implement the ability to send your tax refunds, which in the US are such a powerful source of income for households, and direct those to more than one destination. And that kind of infrastructure well, not necessarily very top of mind for a lot of people or very sexy or exciting, is actually really powerful to enable the movement of funds into savings or into retirement assets. So it's been really gratifying to be able to sometimes operate at that infrastructure level, that one-to-many way that enables other actors to then come along and build on top of it.
Excellent. And if we look to today, then, what would you say are the most pressing financial inclusion challenges facing working families and individuals today, and that maybe differ from when you got started as well?
Well, I think one thing that's shifted, and I'm sure you and your listeners have experience of this, there was a time when we really focused on this question of, is somebody banked or unbanked? That was a common frame. And I think we moved beyond that. And FinTech has played such an important role in creating more different on-ramps into the financial system. So it's nice to start with something that has changed in a positive direction. What I think, to your question, it continues to be a huge challenge for so many of us is, if we want to use kind of jargon, we could call it liquidity, but it is the reality of unpredictable, volatile financial lives. And that is just it's such a powerful force in households. And it's sometimes just really obvious and mundane things. But if you are not salaried, right, which most of us are not, and your shifts get cut in a certain week, right, and your income falls, or on the upside, you get some overtime and you have a little bit higher income, or you work in an industry that's seasonal where the weather determines your income, or you have some other expense volatility, that becomes the consuming issue that we often have to focus on. And so that, I think, is a very pressing concern that we have yet to really solve. I think the second one is more a half full opportunity. There's just such an abundance of evidence that the distribution of wealth there's just so many of us who really don't have any wealth. And that's really what brought us together. And I think we have an opportunity to make a real difference on that sort of generational wealth building. Some of those opportunities are specific in a given market. I'm thinking of the US, and we can talk more about that right now. But we really believe that ability to think long-term about what you have, potentially what you can leave if you're a parent, is really foundational. I think the third one that's a pressing issue is this revolution that may be coming in terms of advice and guidance and information. The overwhelming majority of consumers of households really have never had access to any kind of personalized financial guidance or advice. And I want to be careful not to oversell that. If you don't have enough money, no amount of advice is going to solve for that problem. But at any level of resources, we all want to make the smartest, best decisions aligned with our own priorities. And I think there's an opportunity now that hasn't existed before to extend that tool to a lot more people. And then the last one I'll mention that I think is timely is that as the world has gotten more complex in so many ways, including in our financial lives, there's need and an opportunity to help more of us navigate the systems around us. And I'm thinking here of the workplace, which, at least in many developed economies, our employers play a big role in what kinds of financial tools we get. It's where our income originates. In public systems, and in the US, those include state-run savings programs like 529 education savings, like these things called state auto IRA programs, and what we might call public benefits, right? Many of us get our health insurance, for example, through an expanded Medicaid. A very large number of Americans receive some degree of their food support from SNAP. Obviously, that's not true for every household, but these systems require a great degree of concentration and energy to navigate. And I think there's opportunity to make that easier for people in a way that will improve their welfare.
Excellent. I guess building on that then, what work are you doing at the moment with Commonwealth to help tackle some of these challenges and promote financial inclusion across the industry?
Yeah, thanks. Well, so you'll see the through line. We have really many priorities, but the three big themes that anchor our work right now are the workplace and the employer. And I'll circle back and explain why I see these as important. Secondly, access to capital markets as a way to build wealth. And thirdly, the opportunities related to AI that sit across those first two, but also more broadly. And so we focus a lot on the workplace because it is a coming together of two things that are so powerful. One is a set of capabilities. Employers have the ability to reach people, to deliver information, to offer tools. They are already doing that huge sums of money are spent, especially in the US, on employee benefits. So they have these capabilities. They are where the income originates, and so can help automate and facilitate contributions and deductions and so forth from payroll. They're trusted generally. I mean, many of us may complain about our employers, but I have yet to meet someone who really genuinely believes their employer is actually going to defraud them or is going to send them bad advice or will send them intentionally unsuited, unvetted vendors or tools. And that bleeds into the second reason why we think the workplace is so powerful is you have all these capabilities and assets, but you also have, at least at the high level, aligned incentives. There is just so much evidence that employers are better off when their workers are financially secure. And it's just a simple intuition. I think any of us can relate to that feeling of when we are distracted by something really powerful. I sometimes come back to the analogy of being a parent. And when you are preoccupied by your work or some other form of stress, the quality of, I know for myself, my own parenting goes down. So by analogy, when we show up in the workplace and we're worried about that rent payment that's due, and we're not sure if last week's paycheck is going to include the overtime and will it be there for the rent payments, and the cousin that I lent some money to, do I need to chase them down? And did I make the right choice about whether to borrow from this source versus that source? All of that is distracting from my ability to be present, productive, provide good customer service. There's even evidence that long haul truck drivers under financial stress actually have more accidents. So there's all this evidence. And what it means is that employers have an incentive to focus on their workers' financial well-being. So all of that ends up to a lot of work we do directly with employers and with the benefit providers, including the retirement industry, that shapes what employers can do for their workers. The second thing is this notion of access to capital markets. Again, you've heard me now say a couple of times, we really believe in the household balance sheet and wealth. And at least in our experience, there are a handful of proven pathways for people to build wealth over time. And many of those are getting harder or less accessible. So the classic one is home ownership. Home prices in the US continue to rise. Down payments are harder and harder for people to build up. Obviously, it depends a little bit on where you live. I think you and I are both in large urban centers. We know how expensive the real estate can be. But in general, home ownership is getting harder. Similarly, investing in higher education, that's getting more expensive and harder to do in the US. The third one that comes up often as a wealth creation mechanism is some kind of entrepreneurship or starting a business. Absolutely true, and not for everybody. And I guess you could argue either way, whether that one's getting harder or easier, may depend on the particulars. The pathway that has indisputably gotten more accessible is to actually invest in markets, in capital markets. And FinTech has played a huge role here. But we think there's work to do to make sure that wealth creation mechanism is truly open for families who have not participated in the past. So we do a lot of work there. And some of that work, and now because of some policy changes in the US, this is even more important, is about starting kids in that opportunity early in life to be participants in capital markets. And then the final thing, as I mentioned, is AI. Honestly, we talked about this a moment ago. From our start, we've just thought that technology has such an important role to play in addressing some of these problems. And specifically, starting about 5 or 6 years ago, we really started to focus on AI, which at that point was before the generative AI LLM revolution had really taken hold. So we started looking primarily at chatbots and more of these deterministic models. But the potential here, it's so powerful in a couple of different ways. And we've done some work on this specifically. We have a publication about trust and how you earn users' trust. People want to have technology that solves the problems in their lives. And this AI has unique capabilities to be personalized, or I should say potential at least, to be personalized, to place information in context that makes it relevant, to scale up or scale down to my level of knowledge or numeracy or cultural context, to be available rapidly and close to the moments when I have decisions that I need to make. And all of these things make AI have very strong potential to support the mission we have of financial security and opportunity for so many households. But across all of these, it's been our experience, the outcomes we want aren't going to happen without many of us intentionally trying to both advocate and support the market actors, and in some cases, the policymakers who are creating the world around us. And that's the role we try to play.
It's the last chance to nominate for the PayTech Awards USA. Time is running out. Nominations for the prestigious PayTech Awards USA close on the 4th of September. Don't miss your opportunity to showcase your achievements and gain industry recognition. Submit your nomination today and join the leaders shaping the future of payments technology. Nominate now before it's too late. Just search PayTech Awards USA to get started.
I guess obviously if you've mentioned AI there, you mentioned obviously the potential as well. How do you unlock that potential, I guess, when it comes to supporting consumers, and what guardrails need to be in place as well to ensure these innovations effectively serve low to moderate income consumers?
Yeah, I mean, that is it's such an important question, and I won't pretend that we know the complete answer, but there's some things to offer here. One piece that I think is probably not getting as much attention as it should is around who is engaging with the frontier models and how. I think many of us have seen the figure that OpenAI put out, about 200 million encounters a month related to personal finance. I'm not sure that's the language they use, but that's the essence of it. But what we have not seen is who are those people and what are they showing up to ask? And of course, we don't know with what effect. But I think a lot of us, from our own experience using these tools and from the academic studies we read, are increasingly realizing that how you engage the tools has a huge impact on how they perform for you. This phrase of prompt engineering feels a little bit too reductionist, but there's something about knowing the right questions to ask, knowing how to respond when those models provide you information, knowing when to be maybe a little skeptical, ask a follow-up question. And I think we have seen so little research and understanding about how people who don't have a lot of money, who are often incredibly busy, who may have uniquely complex financial lives, right? Think of somebody who's holding down multiple jobs of different kinds, whose expense structure may be different than a higher income household. So that's an area that we are very interested in, is more understanding how individuals show up and use these tools. And ultimately, so that we can offer, the we here is the royal we, not just our organization, but for example, industry can offer useful direction to consumers about how to use these tools. I think the second thing I've already mentioned is widening distrust of some of these technologies. And in some communities, that is rooted in real history of prior innovations not being offered equally or being used to cause harm. And so this question of how we earn users' trust is really important. And again, alluded to this, I think some of it has to do with asking ourselves, those of us who play some role in providing tools, is this really useful to the person who is living on that paycheck to paycheck reality? It's been our research finding, and again, it's kind of common sense, that if a tool just doesn't work for you, then you're going to dismiss it. And then that, of course, has to be complemented with basic data privacy, with trust in the provider who is delivering the tool. The one additional finding that we found that was maybe not predictable, or it was a little bit surprising around how you earn trust, is that people want to feel that when they use a tool, they themselves are better off, that they come out more capable, more confident. So I think it's easy to assume that technology is a substitute for the user, and that may have some role. But I think in many cases, what we want that technology to empower us, right? To make us more capable. So understanding user behavior, focusing on trust, and then a theme that comes up a lot in our work is understanding how the technology leads to long-term outcomes. So in a shorthand kind of way, we think a lot about the balance sheet for the household as a very long-term North Star, but you can obviously get more granular around what different outcomes are, and just holding ourselves as a field, as an industry, to that idea, like what are we actually achieving for people, is a really important part. So that's not a tidy set of guardrails. It's really just a set of thoughts about how we need to be thinking about this. And I know many folks are doing good work on some principles like transparency and explainability, and all of those things, of course, are important as well.
Excellent. Yes, obviously you're doing a lot of work at Commonwealth, but is there anything you think the industry as a whole needs to be doing more of to help further promote financial inclusion through products or initiatives?
I appreciate that question. I would repeat something I said, which is I think there are all kinds of structural pressures to focus on a very specific piece of a larger challenge, either the challenges that a household faces across their financial lives and across time, or one could say even zooming out what we as a society or an economy face. And that makes sense. We all need to pick a bite-sized thing to sink our teeth into. But what I crave for the fintech industry and the financial industry is to, as much as possible, think in terms of those larger outcomes for the household or for the society. And I think that's important because sometimes, well, I'll use an example. I think many of us have noticed the incredible rise of earned wage access in the US, especially. And I think there's no question, given the strong growth and response to that tool, that it is filling a need for households, right? And it goes back to what we talked about a minute ago, the liquidity challenge. But I think the jury is out whether that ultimately leaves households better off. And in the worst case, a pattern of spending precious resources for a household that may not have a lot of income to begin with to chronically get their pay delivered a little bit sooner. I think most of us can agree that's probably not a good outcome. And I understand that's a complicated industry. There's a wide variety of ways that idea is implemented. So I don't want to paint with too broad a brushstroke, but I think that is an example of where there is a risk that the individual product is filling a need and people are willing to pay for it. And there may be a profitable business model, but it is not necessarily achieving a good outcome for the household and a good outcome for society. And I think there are other examples. The innovations in credit, buy now, pay later, comes to mind as an example of something that clearly is getting a strong marketplace response. But I think we need to ask ourselves whether or not it's achieving a longer term good. So I think the opportunities related to AI are a second area, which we can talk more about. And I guess the third one I would come back to is that this notion of wealth creation, you can think of that as a functional sort of thing on the menu that a particular fintech or firm can play in. That's the one way. It's sort of one more category of financial need. Or you can think of it as an overlay that applies honestly across the board, right? Whether you're in payments or whether you're in somewhere in the credit stack or whether you're in the advice or information business, are you playing a role in helping that household ultimately strengthen its balance sheet? So those are three that I think are exciting opportunities. And one thing that comes up a lot in our work and probably is reflected in that answer is that we are looking for the places that we hope and believe can be good for households, good for society and our broader economy, and good for the providers who are delivering the solution. So I offer that framework too, because I think that's a good test to always ask oneself if there's reason and evidence to believe the idea and the organization is contributing at all three of those levels.
Excellent. You recently wrote in a blog post about the next generation of inclusive financial products as well. What does that look like to you then? I mean, you mentioned AI again there. What innovations are you most excited about testing and scaling in the coming years?
Yeah, well, there's so many here. I'll try to be disciplined. I'll just say again, I think things that focus on workers and their needs, that is always an area. And there's so much happening there. There's good work and new tools, honestly, to help workers pay down debt. For example, student debt. They're the work I've talked about, helping us build up a cushion of cash. There are exciting things happening in the workplace related to financial advice and coaching, including by, very large firms that are famously rigorous about ROI. So that work continues. The second opportunity that I've alluded to, so I'll just say a little bit more about it right now. And actually, it's fun to talk with you in the UK, because for many years, the UK was a global leader with something called the Children's Trust Accounts. And it's this very, very sort of intuitive idea that if we could seed investment accounts for children early in life, preferably at birth, advantages to that. There's so many. Imagine entering adulthood with some kind of seed capital, particularly for a kid who just would never otherwise have that, and how that could change, your material circumstances, having a little bit of money to make it realistic, to get some form of higher education or to put down that first deposit on an apartment or maybe one day on a home, but also just in terms of one's aspirations. And there's actually really good and rigorous social science research on this. Specifically, I'm thinking of a very well-regarded study, long-term study in Oklahoma in the US that showed the correlation between kids who had these accounts set up at birth and the likelihood that they went on to college. And I believe the finding was that correlation or that connection was independent of the amount of money in the account. It was even the existence of the account that had some effect. So this idea has been around for a long time, including in countries around the world, including the UK. And as it happens in last summer of 25, when our Congress passed a very large bill, for the first time, there was federal policy and federal funds, about $15 billion set aside to establish accounts for every child in the US. So those accounts in the legislation are called Trump accounts. Many of us have been referring to them as Trump accounts /530A, which is the section of the code, because there's a precedent of talking about 529 accounts and so forth. And they are part of a larger movement, but this feels there's the raw material here to make an enormous long-term difference at a very large scale. And so there's a challenge there to think about our audience today. If you're in the financial services business, if you're a FinTech, what role can you play in getting the word out about this opportunity, in helping people to take action, in reminding the parents at first, but over time, the kids, as they grow older, that they have this? It is, in a sense, a $15 billion subsidy for household financial well-being. And it's actually more than that, because private philanthropists have now pledged, well, I know the Susan and Michael Dell, for instance, have already pledged $6 billion. So the federal funds matched with private philanthropy. So that's an area of opportunity we're incredibly excited about. I'll just hit you with two more. We've done some really, really interesting work on caregiving. It turns out there are 49 million Americans who are providing unpaid care for someone over the age of 50. And if you zoom out and think about other forms of caregiving, including potentially kids, those numbers get even bigger. In some research we did with the audiences, or the audience we think about, the households living between $30,000 and $80,000 in the US, so that's basically under the median. A third of current folks who are providing care to elders said they're spending somewhere between $1,000 and $5,000 out of pocket every year on caregiving expenses. And the reason I call that out is that I think sometimes when we think about this caregiving issue, which is so large in our country and is such a burden on so many households, it can be overwhelming. But it turns out that $1,000 to $5,000 is a huge deal if you're living on $50,000 a year. But it's not like we can't make some progress against that. So we're thinking a lot about what the opportunity and the need around caregiving is. I think this is an issue that is only going to grow in importance. A second one that I'll call out, by some estimates, there are multiple trillions of dollars in the US that have been put into retirement accounts and have become lost. And by that, it means either that people aren't really sure where they are, they know they have them, but they kind of lost track, or in some cases, they literally do not know that there is an account that they started. Just to dive deep on that one for a quick second, in the United States for the last 15, 20 years, we've had this revolution in automatic enrollment, right? We're automatically enrolling people into workplace-based retirement savings plans. And that's been so powerful in lifting participation. But there is a risk that some people get automatically enrolled and don't really ever totally understand what it is that they were automatically enrolled into. And then they change jobs and they get some kind of terribly dense, overwhelming notice about what they're supposed to do to hold on to their money, and it goes on a pile and it gets lost. And especially if those folks are not making a lot of money, that's just an incredible tragedy that precious paycheck dollars went somewhere with good intent and they're floating out there and they're lost. And so we're incredibly excited about trying to reunite people with these accounts. In fact, we did some research, just pulling up my notes to make sure I got, so in a national survey we did of those living on low and moderate incomes under $80,000, 39% of respondents turned out to have more than $40,000 in retirement savings that were lost. So what an opportunity to reconnect people. I think there's so much work there, and FinTechs are already involved in that, but I think that would a place to think about. And I guess maybe I'll end with this, again, kind of hoping that some of our listeners today are entrepreneurs and have that ability and that track record to take good ideas and make them happen. There are a variety of public resources that are underutilized. So these $15 billion in seed funds for kids that I mentioned under the Trump accounts would qualify. There's something called the Savers Match, which beginning in January, for the first time, will be a genuinely useful and accessible federal match for low and moderate income people who put money into retirement savings. This is not a form of public money, but this multiple trillions of dollars that are out there unclaimed or lost in retirement accounts is another example of a resource. And then there's a whole infrastructure of public benefits in the US that people either rely on today or are eligible and are not claiming. And that includes something called the Earned Income Tax Credit that's so important in the US. And so I think there is a great opportunity for households that are under financial strain to play a role in bringing new resources to the households, helping them find new sources of income or new ways to increase their holdings. That's just can be so powerful.
Excellent. And to finish things off here, then I mentioned at the top of the show that you outlined Commonwealth's Vision 2027. What are the key priorities there, and how are you working with partners to help shape what comes next?
Yeah, well, I think actually through the conversation, we've probably covered them. So I'll just repeat. Our big three priority areas are the workplace and employers for the reasons we talked about, wealth creation, especially through capital markets, and the application of technology. Those are the anchors that I think that are going to power our aspirations. But I think it might be worth just saying a bit about what this notion of working with partners looks like in practice. And what we find there is that there are so many actors, whether we're thinking about employers or financial service firms or some of these vendors, who have incredible capabilities and reach. And what they don't have that we're fortunate to have is a specialized focus on people that don't earn a lot of money. And they don't sometimes have the ability to see or to talk about how the choices they make and the work they do are not only about advancing their own institutional interests, as they have to be, but tie into larger societal challenges and needs. So what we have built a practice of is engaging deeply with firms that have these capabilities that, quite frankly, we as a fairly small actor do not have, but can unlock and support them in finding ways to make an important difference. And so what that looks like in practice is bringing specialized knowledge of their customers or their workers who don't earn a lot of money, an ability to bring research findings from different contexts, an ability to roll up our sleeves and go out and try things. And we've had a chance to do that just with an amazing set of actors. Work we've done with United Parcel Service, or recently looking at and studying the impact of features that Starbucks has rolled out for its workforce. Taking those insights then and talking about them in a way that can support and reach and frankly influence the strategy of actors that we've never met, right? That's what we call kind of inform and influence. And then in some cases, taking all of that data and those findings and talking to policymakers to help them inform the choices that they make. We're very proud to have contributed to something called Secure 2.0, a piece of legislation in the US in 2022 that, for example, for the first time made it possible for employers to automatically enroll workers into emergency savings in the workplace. That also, for example, allowed employers to match into retirement savings contributions their workers make to pay down education debt. So that's a really interesting new innovation. So just to say that's part of the work as well, is to make sure that what's happening out there by leading actors, whether it's FinTechs or large corporations, informs public policy. So to answer your question, as we think about the vision for the future, that approach of deeply engaging with the actors that make up the financial world we live in is an essential part of it, and gets back to what we talked about really at the beginning of thinking about what are the large system level changes that we want to pursue over long periods of time. I'll wrap that up by saying one thing I like to do sometimes is just pause and think about what is the world that I personally would like to live in and that I would like to contribute to and for us to contribute to.
And it's something like a world where every kid starts life with a shot of a stronger balance sheet, of a wealth creation over time, where the stress that informs so many financial choices day in and day out, week in and week out, comes down, where household balance sheets strengthen, and where maybe one day every household has access to personalized, non-judgmental, timely information and guidance that can be placed into a longer term context so that when people are making decisions today, they get the same kind of support that honestly wealthier people do to zoom out and ask how the decisions we're making now are going to result in long-term impacts. And I think we see the makings of all of that around us if we can find the right ways to seize the opportunities.
Thanks again, Tim, for chatting with us today. To close out the podcast, we have our now infamous FinTech jails. This is where we ask for an industry term, buzzword, or trend that you've seen or heard enough of. Or, of course, you can free one of the previously incarcerated terms. So what would your selection be for this week?
So I want to nominate this language, financial literacy. Maybe that's a phrase I think we can put in jail.
Okay. Why do you think this one deserves to be in jail?
I think there's two reasons that come to mind. One is the language implies illiteracy, and who among us wants to self-identify as sort of being illiterate? So there's that kind of very straightforward, maybe superficial, but important element. And I think the second thing is that phrase comes from an outdated notion of what we can constructively offer to households. And at least in my experience, it tends to come up a lot among industry players or their variations on it. And the idea here is that people just lack what they need in terms of knowledge. And if we could comprehensively educate people, then that would make such a difference. And often it sort of hovers over it as a sense that the fundamental issue here is that individuals are just not adequate. And the way we change things and get to a better outcome is we try to help them make better choices. And in my view, that's just not how it is. We all have an important role to play in the decisions we make. I believe that's very important. But what we see over and over again in our work is that people are making actually incredibly good choices given the options available to them, and they're operating under a lot of strain. And so what I would offer instead is various different phrases. One is financial capability, that we're trying to give people the capability. Another one that we use sometimes is that people, they crave actionable knowledge. And I have a little bit of an anecdote on that I'll share in a second. But what I think we want is we want to figure out what information do people want. That's critical. It never works to try and shove information down, at least not adults' throats. They have choices. Their time is limited. They're not going to do it. So we need to know, what do people crave? When do they crave it? And why, right? Because they want to do something. They have a decision to make. There is something that is causing them. And when we adopt that mindset, now we can deliver something that is genuinely useful. And of course, today, as we talked about, that includes the capabilities that come with AI in terms of personalization and kind of scaling and lack of judgment. I honestly wish I had a dime for every time I've been in some kind of a conversation that tacked towards what we need is a new financial literacy curriculum. And if we could just offer that, what a difference it would make. And I'm quite skeptical about that. I wanted to offer one piece of color. As I mentioned, we do a lot of work trying to open up access to capital markets for people. And we did some work together with a partner organization about what's a framework that enables somebody who doesn't have a lot of money, but has raised their hand and said, I kind of would like to be an investor. And what we heard was, first of all, you got to have enough money, right? So that just makes sense. But the good news is, even if your baseline income is not a lot, there are these moments when, it rises. Maybe you get a large tax refund or you get a bonus. Second thing is we need access to tools that help us get to markets. And FinTech has done so much to close that access gap, right? And even with $25 now, you can open an account. But here's where it gets interesting. Thirdly, they said, I want to know more, which gets back to what I said a second ago. People, they send signals of what they want. And I think people have the wise intuition that investing in markets is not the same as putting money in a bank somewhere. And they crave understanding about that. And then the last thing was just super interesting. And it was that even if you solve for those first three, many people said, but let's be real, Paul, I'm not an investor. Well, what do you mean? Well, that world doesn't really, I'm not welcome there. I don't belong there. When you sit with the idea that maybe you come from a family where no one has ever been a participant in capital markets, your community, that's not the norm, it made sense that there would be this kind of invisible barrier. So we called that investor identity. We've done some research and run some pilot studies, and it turns out that you can shift that investor identity if you actually get people into markets. We've done that by giving them small seed funds so they could start with, if you will, house money. And then getting them through 6 months seems to be where we start to see a turning point. So to go back to this notion of financial literacy, that experience of helping somebody actually get into, be a participant in capital markets over an extended period of time, responding to their request for information, is about as different from, here's a curriculum, go teach yourself what you need to know and then come back. So I wanted to use that to illustrate the contrast.
Excellent. No, sounds great to me. I think you've made a very well-rounded argument there, so I'm more than happy to add financial literacy to the jail this week. And we'll see later down the line if anyone wants to advocate to break it back out again. But for now, Tim, thank you so much again for joining us today. It's been a pleasure.
Thank you, Paul. Thanks for the time. Appreciate the conversation.
Well, that's all we have time for this week. Thanks, of course, to Tim for joining me. As for FinTech Futures, you can find us online at fintechfutures.com. And be sure to follow us on LinkedIn to keep up with the latest FinTech news. If you like this podcast and our other episodes, you can subscribe on Apple Podcasts, Spotify, SoundCloud, or your favorite podcasting service to get notified about future episodes. Thanks as well to Arama for editing this podcast. You can check them out at arama.tv. As always, thank you very much for your support, and we'll see you soon for another episode of What the FinTech. But until then, goodbye.